Good morning. I wanted to start with a quote from Darwin, excuse me, a quote from Darwin, who said, "It's not the big or the strong who survive, but the ones who are most adapt to change." And looking at the internet, I think we're not talking about an evolution. We're not talking about something that is going to change a bit what we're doing. We're talking about a revolution, and the revolution is going to happen in things that we've never done before, not in things we've done before, and we're just going to do them a little bit better. So I challenge you to look at trading, and I think you'll find that, I hope to convince you that trading will be part of your strategy, will have to be part of your strategy to survive in the new millennium. So the question I wanted to pose to all of us this morning is, what is your business when minutes are free? And free, I mean that they're going to be just incorporated into the bundle that you'll have to offer your customers, and you won't be able to go and charge the premium that we can charge today for providing the basic services that are offered out there. So the problem with minutes, or the problem with basically the core of the income that most of us have relied on the last 100 or so years, is that although we have to continuously grow the infrastructure because there is 15 to 20% growth on the minute side, on the actual usage side, we have tremendous pressures coming in from deregulation, coming in from the fact that technological innovation is taking a product that we used to depreciate over 20 years and is depreciated over 5 years and going down to about 3 years, and as well as complete commoditization of the basic pricing and the basic components, the units that we're actually selling. And one of those components, one of the problems in this industry is that if you compare telecommunications to practically every other industry known to men, you'll see that telecommunications stands out in a very, very clear way. And SG&A, which stands for Sales General Administrative Costs, in telecommunications is, again, on average, 25% of the cost of basically the goods that we sell. And again, if I'm looking at the Industrial Revolution, if you think about what happened in the Industrial Revolution, there is a major assault on the cost of goods. So it took us about 100, 150 years to modernize, standardize, and basically commoditize the manufacturing processes so we could make things very quickly in huge scale at a very low cost. Well, the internet is coming in and completely revolutionizing how we are basically attacking SG&A. It takes the SG&A component of our business, and just to quote Bernie Ebbers, he estimates 60% of his cost is going to be SG&A 3 years from now, up from 25. So how do we take that, again, coming back to the new revolution, the internet revolution, and we attack the SG&A to bring it down, not just to the level that the other industries are enjoying, but actually bring it below that, because after all, we're dealing with ones and zeros. I mean, we don't have the problem of shipping a roll of steel, which, again, like was said before, I dealt with, or chemicals or anything else. We can actually move our commodity anywhere in the world with a split second with zero cost associated with that. But still, we have the highest cost, even though we have essentially the best product out there. So what I've done is really took the different tiers, tier 1, 2, 3, voice of IP, CLEX, and ISPs, and took several examples of companies and looked at the components that they've published. These are all public companies, and you can do the numbers yourself. It's published right on their 10Ks that they give to the SEC. They publish in the SEC every quarter. And what you can see is, again, that there are some companies who are running not at 25%, not at 40%, not at 100%, even higher than that. Some of them running at 200% of revenues. And what we're saying is essentially that this is not sustainable. And what you have to do is you have to completely re-engineer the business, because if you continue this way, you essentially not just won't be able to compete, but again, with all the slides we've seen yesterday and the day before, you won't survive. So the ones who are adapt to change, the ones who are going to basically incorporate new capabilities, new services, and not make the old services better are the ones that are going to survive. And again, look at Mr. Christensen's slide where he had the blue area and the green area. And what we're talking about is new stuff in the green area. Okay, there is some improvement, marginal improvement you can get in the blue area, but in my opinion, it's a waste of time. So the impact of basically trading in SG&A for SG&A varies between the different tiers. And what I try to do here is basically dissect it in a different way and look at it as far as an impact to your valuation, to your bottom line. And most of the people here are valued based on your returns to shareholders, based on the margins you can squeeze out of the products you're selling, and basically growth in revenues and growth in bottom lines. And what happens is that essentially you have components here that can be squeezed, components that can be re-engineered, but some other ones we can't really do much about. So as you can see, Tier 2 and Tier 3 actually carriers have an advantage on the big players because they essentially can shave more out of their costs quicker and essentially migrate or adapt to this new world and incorporate new services that customers actually want to be offered. So going back to the minutes question, today average cost per minute is about 24 cents. SG&A, we took the lowest example, 10% SG&A would be 2.4 cents. The cost of minutes is 87%. We have a 3% margin, which is a very tight environment to be in. Again, this is the wholesale environment. This is not the retail environment. What happens is as basically the price per minute drops very rapidly on the wholesale level, in many cases, I mean, we have customers who are using trading to subsidize the fact that their network is not used enough. So they're selling below cost. What it does is basically pushes the prices down to a level that is basically unsustainable from a cost standpoint. So you haven't really adjusted your SG&A. Your cost of goods is still there, but your revenue doesn't cover that cost. So unless you really slice and dice that SG&A and you really put a full court press on this issue, you can't survive in the wholesale environment. You won't be one of those operators who can actually offer termination or origination or some segments of transport to the industry because what we call you won't be a market maker in your market. So an exchange is not a new model. I mean, I'm not standing here in front of you and trying to reinvent the world. I think the model has proved itself in other industries, and probably if you're looking at some of the most efficient industries out there, which is the currency industry, where you have a global electronic exchange that allows you to move any currency anywhere around the world in split seconds, or you're looking at the financial markets with the stock markets or other markets, you'll find that essentially what they've done, if you're looking at them 50 or 70 or 90 years ago, they went through that migration already. They had these huge SG&A costs. They had all these unstandardized contract, unstandardized relationship, unstandardized product, and the industry as a whole decided to move to the standardization, to move to the commoditization of the basic product because they realized that by doing that, they'll increase the volumes tenfold. And if you're looking at the volume of trade on NASDAQ or on the New York Stock Exchange or on the currency markets over the last several years, I don't have the figures here, but the volume has increased dramatically. So the challenge here that I'm giving all of you is the fact that even though, like we said, there's huge resistance to change, I think that an exchange for telecommunication is an inevitable outcome of this industry standardizing around basically the IP backbone and the fact that essentially all of the differentiators that we used to have where our product could never be compared to anything else is now gone. They're out of the window. Essentially everything is now standardized. Everybody's trading the same packets worldwide. So to operate an exchange, just like the currencies market or other markets. What you have to have is several elements that without them you will not be able to actually have a viable offering. And what we've been doing since 1994, way ahead of anybody else, has been essentially not just working on the physical layer and the physical implementation, but also working on all the intellectual property and everything else that is necessary to make an exchange possible and make it operate in the telecommunication environment, because telecommunication has that physical layer that doesn't exist in stocks. I mean, when you trade a share of IBM, nothing really happens in the back end. There's no runner that runs from one side to another and delivers your stock certificate. When you trade in telecommunications, you actually have to handle the ones and zeros that flows through the pipe from the buyer to the seller. And just to give you an example, we ran a conference in New York where we had about 140 participants. It was a first trading conference. And we thought, we're going to have, I don't know, probably 10 people outside the industry. 50% of the people that came over were Wall Street guys who basically said, we want to play in this game. We want to help all of those customers we have hedge risk and manage long positions and do all these other things. So we were surprised at how welcoming Wall Street was compared to the telecom industry. The telecom industry came in because they were skeptic. They sent somebody to take a look at this thing and see if there's something there. So we had a panel where we put a currency trader, we put a telecom trader or a telecom company, and we asked them a simple question. We asked basically the currency guy, okay, you are moving $1 million worth of currency from Japan to New York. How long does it take you, and how much does it cost? And he said, well, it takes me about 15 seconds. I make a phone call, or I look at my screen and I just place the trade, and the transaction is completed in about 15 to 20 seconds. And it cost me about 3 cents for $1 million worth of currency. Then we looked at the guy on the other side and we said, okay, well, you're in the telecom business. You have the same ones and zeros to move. How much does it cost you to move $1 million worth of capacity? I said, well, I have my legal department. I have 15 signatures. I got the game of golf that I have to play with the guy, and maybe a dinner or two, and I have to negotiate certain terms and conditions, and I got to go back to my legal department to make sure that the changes to the contracts are fine. And when I'm done with it, it's anywhere from maybe 4 weeks to 8 weeks, depending how long it took me to actually give those orders and put them into the system so somebody can provision them and implement them, and they usually go at the top of the pile and have to go there once or twice to make sure that they actually get done. And it cost me about $50,000 to $60,000. So that gap is what we have to work on. I'm not saying it's going to be 3 cents, but it cannot stay $50,000. And again, it's the same ones and zeros flowing through the same pipes. So if we can get an automated physical delivery, if we can get dynamic routing, if we can get centralized settlement and neutral and anonymous trading, we can have all those components that we already have in other industries. We could have all the benefits. We could increase the volumes tenfold, and we will be the best benefits. Nobody else. This is not good for somebody else. This is not good for the consumer. Yes, it is, but it's much better for us than it is for all these other guys. Because we're all sitting on pipes that are depreciating faster than ever before. We have a commodity that is generated every second. If I have a 40 gigabit circuit, I generate 40 gigabits every second, and it depreciates to 0 every second. If I haven't filled it up, if I filled up 10%, 20%, the rest of the capacity vanishes. If I haven't monetized it, it's not there anymore. Now, it was fine when I could generate $4 or $5 billion in profits on my revenues because nobody cared. Wall Street was happy, everybody else was happy. Those days are gone. The pressures today, the new players that are coming in and saying, we're not going to play Gary Winnick, saying I'm not going to play the game by the old rules. I'm just going to sell the circuits for whatever, above cost. And it just, completely destroyed the transatlantic market. So again, I think I described this pretty clearly. Again, we have tremendous cost in establishing these relationships. And again, going back to NASDAQ, NASDAQ has 5,000 members. And if you think about it, if they were operating like phone companies, they would have 5,000 contracts with each other. And each contract would be a little bit different. I mean, I know, I've been in the telecom business for over 10 years. I don't know any company who has 2 relationships that have the same contract. So if I have 50 relationship or 100 relationship or 100 cross connects, each one of them had unique negotiation, unique terms and conditions, unique settlements, unique legal amendments, and so on and so on. The 5,000 NASD members have all agreed to join a certain club. They all agreed to basically standardize the terms and conditions, and that's why they can transact, they can buy or sell anything in an instant and not worry about all these other things, all these 6 points that are mentioned here. And that's one mandatory step in this environment. So our members, people who join our exchange, it takes them a while. Some of them it takes over a year to figure out that this is not just another cross-connect, this is not another bilateral relationship, but essentially we're joining a club where we have a multilateral relationship where we're actually plugging in our capacity. We're taking our entire network and we're plugging into the marketplace. And what we're doing is we're essentially allowing a trading environment to control the floodgates into our network. So when we have too much pressure on our pipes, we open the floodgates and those pressures flow into the rest of the networks that are plugged into the system. When we have a low pressure in our network, we don't have enough traffic, we go to the screen and we price ourselves in a way that allows pressure from other networks to go into our network. And essentially we have a club where all the members are helping each other increase the volume, because that's what it's all about. And then all the issues about quality and all the other elements that are necessary here are essentially solving themselves, because price is the one that determines all the elements that are missing there today. And what this allows you to do is essentially build a whole new set of services, and financial services and retail services and corporate services and wholesale services that don't exist today. A simple example. The futures in oil, the contracts that are trading the futures in oil, okay? For every 2 contracts that exist in reality, for every 2 barrels that exist in reality, there's 100 contracts in futures. So the volume of trading is not 2 times bigger, 5 times bigger, 100 times bigger. It's tremendous. So it justifies essentially the entire industry existing just for that, just for basically people being able to hedge the cost of energy into their production cycles, into basically how much it's going to cost me to manufacture, or how much it's going to cost me to generate electricity, or how much it's going to cost me to do anything else. We don't have anything like that in telecommunications. And I bet you that 5 years from now, not 20 years from now, 5 years from now, the White House is not going to be talking about how the price of oil has changed the index or influenced inflation, but the price of bandwidth have changed the index or influenced inflation. Because as we move to be a service economy, this component, the bandwidth component, is becoming the dominant component in the cost of goods or cost of services that we provide to both our nation and the other nations around the world. So I took the liberty of taking one company. I took the name out because I didn't want to offend them, but took 99 revenues, which were about $600 million. Look at their SG&A, and again, took just their wholesale portion, didn't take all of their SG&A, and put it at 10%, being very generous. Looked at basically the incremental revenue. What did they increase during that period of time? How many minutes that represented? Looked at the incremental SG&A as a component of that, and derived at basically the cost per minute for doing that business, for basically increasing those revenues in the wholesale level. So basically, the way we operate today, what is the cost of running, of basically the true cost of each incremental transaction in our network? did the same thing through the history that we have in our exchange and came out to a very simple conclusion. It's 10 times, not 2 times, not 5 times, 10 times more expensive to run trades, or basically buy and sell, the old way than it is the new way. Forget about the new incremental volume, forget about the new products. Just, again, doing the old thing a little bit better is 10 times cheaper. Now, I bet you that the impact of new products is going to be not just 10 times better, but it's going to be 100 or maybe even 1,000 times better, because it's going to open, again, the industry to a whole new revolution that we haven't seen yet. And like people on the internet say, only 5% of the internet was invented yet. We're yet to see the 95% that nobody knows what it's going to look like. Now, the people in this room are sitting on the infrastructure that's going to essentially empower this entire revolution. And instead of making it available to everyone as fast as possible and filling up those pipes as fast as possible, we're basically trying to figure out how we don't make sure that we don't commoditize our product offering. That is not what it's all about. I'm sorry, maybe I'm in my own camp sitting here by myself, but I think it's all about trying to supply as much as possible, as fast as possible, and get those 5 or 6,000 new startups that are out there, everything they need to fill up those applications, so the billions of consumers worldwide will consume as much capacity as possible, so we can basically get as much revenues, as much profits as possible. So I think I made the point, but just looking at it a different way, looking at the time element that it takes to do a transaction. An average transaction is in about 8 weeks, and this is the cost to the buyer, cost to the seller. And we've ran the process of how long it takes to do all these elements, the contract, provisioning, settlement, clearing, risk, and so on. And again, we came up with 1 hour. And I think 1 hour is kind of like giving a lot of credit, because usually we do transactions in about 15 minutes. So the impact is not just in money, but it's also in time. Your ability to go and deliver things instantly to a whole new set of market, that the green area, that we don't even know who they are. We don't need to know who they are. We plugged our capacity to the exchange. We priced our network out there. And in areas where we are a market maker, we will be able to dominate the space. In areas where we are not, we will know immediately that we're just a net buyer. And that's what happens, again, on Wall Street every day. So the impact to essentially market cap, as you can see, is tremendous. If you translate those savings into what Wall Street, the incremental 200 basis points that essentially Wall Street will give you for the fact that you have had those savings. And again, this is not talking about new products. This is just talking about shaving your existing SG&A. You would see tremendous impact. And again, the smaller you are, the better the impact. But we think that none of the executives here would object to a 7.5% increase in basically in your market cap, just because you decided to essentially trade with your partners. So I've concentrated only on one element, which is the SG&A cost. I could spend another 5 hours here going through the other parts of which are the speed of the transaction, risk reduction, incremental revenues, and so on and so on. But what they're all talking about are essentially enhanced margins. Ways to basically take something you're already doing and doing it a little bit better. And I hope that the message that I'm leaving you with is that essentially there's no other way. I mean, this is something that we all have to do, and we have to do it as fast as we can. Just to touch a point on utilization, this is the bell curve, 24 hours. This will be 1 day, and we have 365 specialized charts like this in our network, essentially. And we have our basics traffic, we have other traffic, and we have a reserve. But essentially, in the industry, an MIT survey that was ran shows that the average utilization worldwide is below 20% as an average for the entire capacity that we have in our network. So just give you an idea, if I was in the airline business and I was running at 20% utilization, I would be out of business day one. That's why they invented Sabre and they pushed the utilization to the 70–75% environment. With a digital commodity, what we're saying is with trading, you can increase that 20% to about 80% without doing too much work. Then it becomes a little bit more difficult. But that incremental, all this gray area that is not being used today can be monetized and can be monetized very quickly on a trading environment without any additional cost. It just goes right to your bottom line, goes right to that market cap that you're trying to work so hard on. So again, to conclude, like I said, the internet revolution is an all-out war on SG&A. And if you want to do it right, you have to basically find the most efficient way to implement the re-engineering or reorganization of how you're providing the services today. I thank you very much. Thank you for your time.